Yeah, KB
These
Home,
stocks are getting killed.
They checked all the box of an absolutely atrocious earnings day. Missed on revenue, missed on sales, home deliveries down, backlog down, but it was on the earnings call. KB Home said, the CEO, the past 2 weeks, traffic has softened, and he blamed the Middle East war, which dovetails with, of course, the fall in consumer sentiment. So big red flag for me on KB Home. Not feeling it. Awful quarter, awful outlook.
Yeah, it's a real, it's like a chicken or the egg. I mean, look, like they are neither in control of the geopolitical conflict nor are they in control of interest rates, but like rates are higher because of the war. I don't think people see war. I don't feel like people see war and say I can't buy a house. They see rates higher. They see the mortgage rate back up to 6.5%. They say now I can't buy a house.
Didn't it cross 7% yesterday? I saw somebody posted on.
Did it go that high?
That's insane.
I thought the 30-year fix was around 6.3, 6.4.
It's been rising.
Like, I know it's been rising.
Significantly.
That was like 2 days ago.
This is awful. Yeah, but anyway, awful quarter for KB Home.
All right, speaking of stocks that have not been performing well, I want to do a little software, get your take. I don't think you and I have talked about just what you make of the SaaS apocalypse that we're seeing as a result of all these fears about AI.
Well, I get why the market or investors are scared about this, but I still come back to this view. The notion that Salesforce is going out of business tomorrow is not realistic. I mean, it's just not going to happen. Are they going to go out of business next year? No, they're not. I think Salesforce is very much playing in the AI agent game. I think a lot of companies have reinvented themselves. I talked to Block 2 weeks ago when they laid off like 40% of their workforce. Yeah, it was a tough decision for them. They're going to get more efficient, but they're innovating in AI too. I just have a hard time believing companies that you and I have grown up covering the past 10 years are going to completely vanish. I'm not a fan necessarily of ServiceNow and their business model. I think they have they're valid concerns with a company like that, but still, they're not going out of business tomorrow.
Well, I mean, I don't think anyone thinks they're going out of business, but I feel like, I guess I'm also just, like, how does a management team that thought that they should have a 12 EBITDA multiple or whatever it is, like pick your number, whether you want to do price to sales, which kind of feels like that has to go away because the recurring revenue model where you say we should be 10 times sales, like that feels like that's over no matter what. You just have to operate in a different environment in terms of what investors are going to pay for your business. And now you have all these downstream effects of like, how do I issue RSUs? Personally, I'm going to have a different financial picture. I mean, I look at a stock like Atlassian, ticker is TEAM. They have Confluence, Jira. A lot of people use these tools. Stock, I think, was down 7% yesterday. That stock goes down every day.
Yeah.
Like a stock's
people
down,
hate it.
Yeah, but it's like, okay, I don't think that company's going out of business. But there are a lot of people at that company who assumed the stock would not be down 60% this year, that the stock would not be down 70% over the last year. And it creates a lot of internal strife when now you have a team that's just, for lack of a better word, a little bit poorer because they have a bunch of the company's stock in their portfolio.
You know what is interesting? I was like, it's weird, to go out to dinner with some of these executives and they're engaging with you in conversation, but at the same time they're checking their phone to see how much work their agents are getting done. I can't tell you how many leaders have like dispatched 15 or 20 agents to run their life.
Do you think they're doing that just because they know you're there though?
No, they are checking in on work tasks. Like this is a wild thing, and every time I see this, I'm like, I get it, and I just think we are on the cusp of major layoffs at these tech companies, more so than we have before. And I think back to what Jeremy Allaire told me last week. When I talked to him, he's like, the scrutiny that is about to come for companies that are not laying off workers in the age of AI, that moment is coming. And if you are not aggressively firing people in the back office and telling the street how you're using AI to replace their jobs at next to no cost, you're going to be screwed, and you're going to be screwed in a big way.
So that you jumped my last point I wanted to ask about, which is because you've gotten a lot of executives to give you pretty scary predictions about all of this. So you're taking it as that you think this is going to come through. Because I see a lot of that as that's of the moment today. If you want to manage your stock price today, then yes, you would go ahead and you would say, we should go and fire whatever it is, 40% in the case of Block. I look at a stock like Circle, fell 20% yesterday because there's a problem with the legislation.
They only have 1,200 employees. So, I mean, how much more?
Only 1,200
Only
employees.
12.
No, but I think it's like, I mean, if my stock is liable to go down 20% because there's unfavorable regulatory developments, I might think there's too many people who work in my company. But I'm sort of, I don't really think I'm a contrarian at all, but I'm inclined to zag a little bit on the mass layoffs piece of this conversation and just think that the flex is going to start to be, look at OpenAI. They said they're going to double their staff this year. The flex might end up being, we're hiring into this environment because there are businesses that are struggling as a result of the AI overhang that have to lay off employees. And I'm not 100% convinced that the work you're getting back from your, agentic, you overlording a bunch of agents is of the quality that people want. And moreover, I don't think executives want to do that kind of work. Like executives talk to people and they run meetings and they represent the company's interests. The idea that you can lean out your team and then you as the executive will orchestrate all these agents, that's not work that you want to be, that's not the job of an executive.
Well, the agents are for their jobs too.
I don't think they are. I don't think they are.
I'm partially kidding.
I say it as a joke, but I'm actually serious that the thing with AI is if you're in meetings talking about how much you're using AI, whether it's true or not, you're not going to get laid off because of AI. If you're not in meetings representing your selfish interests and either fibbing about or gassing up how much you're using these solutions, if you don't have that platform, then you might have a problem.
You know what's really got me? It got me, so Amex CEO, Steven Square, dropped his annual shareholder letter this morning, and he spent probably 75% of it talking about how they're using AI. And when I talked to him yesterday, he was explaining how AI is being used in their call centers, and he went on to say AI will replace many mundane tasks. And I really went back and thought, why can't Amex cut their employees by 25,000? Just given how AI is permeating their business. I look at insurance companies, like the example I just gave. Look at Verizon, look at AT&T, look at T-Mobile. You call up these places, you're talking to robots now. Before you can't even get a human.
So that was what I was going to say. Is and we'll leave it here because you got to go after this. But I'm not an Amex card holder, but I have the Sapphire Reserve, whatever. If I have a problem, and I'm paying $800 a year or more for my credit card,
want a human.
I want a person, and I want someone who's gonna troubleshoot it as a person with me, because I'm not calling for a minor issue. I think there are AI solutions around, okay, did you buy $1,000 worth of whatever in a city you're not in? No, I didn't, thank you, blah, 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 replace the card. But if I have a real problem, I'm gonna be upset if I call an Amex or a Chase call center and it's not a person.
Well, you got to get the new Robinhood Platinum Metal card, man. You seem like a Platinum Metal card guy. I mean, you can just drop it on the desk, let everybody know it's a Platinum card, and it's a flex. I
will say the thing with the Reserve is it's laminated, so it starts to peel over time. So I'm due to get a new card, but the one that's peeling.
You don't have the corporate Amex?
Well, I do, but that's the green. It's a green card.
I will say this though. I want to just real quickly say this.
There you go.
Look, when I call Amex, a human still answers the phone. I don't want to get yelled at by Amex.
There you go. All right, you got the next half hour here on Yahoo Finance. That's it for Morning Brief. Julie Hyman reportedly back in action tomorrow morning.
Breaking news.
Yeah, breaking news, exactly.
Good Wednesday morning from Yahoo Finance's New York City headquarters studios. I'm Yahoo Finance Executive Editor Brian Sozzi. Here's what's on my mind right now. First, markets are in wait-and-see mode as President Trump says he has given Iran a 15-point plan to end the war. Expect market volatility to remain elevated, and don't be so quick to trust those rallies, even though I know you really want to trust them. Two, I am digesting this note from Morgan Stanley's Mike Wilson, a closely followed fella in Wall Street circles. He thinks the oil price spike will not end the current business cycle. I'm not sure I entirely agree with this one, but I will put it to my opening bid roundtable in just a second. And three, awful earnings report from KB Home last night. I don't really care about the company missing on the top and bottom lines and cutting its full year outlook. What I do care about is the CEO hopping on his earnings call and saying the Middle East war has hit consumer home buying trends in the past 2 weeks. Not good, not good, and not good. Here on the Opening Bid Roundtable, Tim Urbinowitz, Innovator Capital Management Chief Investment Strategist, alongside Yahoo Finance Senior Reporters Inez Ferre and Jennifer Schomburger. Tim, I want to start with you here. Market's a little bit of in a wait-and-see mode here. You heard me mention at the top about these rallies that might pop up on positive news as it pertains to the war. Should you be trusting those rallies?
Well, Brian, I think you have to be very cautious here. I mean, obviously the market's going to jump up on good news and jump back down just as hard on any negative news that you see, but we just don't see any easy off-ramp to the current solution. And Brian, the reality is, the longer this conflict goes, the longer oil prices stay elevated, more the odds of inflation being sticky because of this go up. And that's what we need to be cautious on. We don't see an easy off-ramp here, so we think it's really important that investors start thinking about protecting their portfolios from inflation, higher interest rates. It's great to see the rally this morning, but I would be skeptical.
Inez, give me a state of play on what you're seeing on oil here this morning.
Sure. Well, we're seeing oil now reversing, so we're seeing it tumbling this morning. This is on a report that the U.S. has sent a 15-plan ceasefire plan to Iran. China also urging Iran to negotiate. We heard President Trump yesterday saying the U.S. is negotiating with Iran, and then also sending some 3,000 troops from the 82nd Airborne Division. And this is important because this is, as the U.S. is sort of weighing what to do about the Strait of Hormuz, because strategists keep telling me the Strait of Hormuz is really the key point here, and it has to be reopened. You have to see oil flowing through there. There's been a little bit of trickling of that, but still you have to see the entire reopening in order to get everything back flowing again. And even so, you're still going to see some of the infrastructure that has been destroyed here, that has to be put back online. So this is going to be longer than perhaps anticipated. And to these moves that we're seeing now, also, look, if this war were to be over, let's say in a week or in 2 weeks, you would see oil going down even further. But yeah, the question is, how long will this last? And if oil stays at these levels, or if Brent goes to around 100 again, I mean, at some point, you have to start talking about also demand destruction, which is what JP Morgan has been talking about in Asian countries right now.
Jen Schomburger, good to see you as always there, my friend. My morning started with, so I'm coming to the train, Jen. I'm getting my caffeine fix in, reading this note out of B of A, and they were talking about the Fed and inflation, and I scrolled down to the bottom, and they didn't rule out a potential rate hike. In fact, they said it's an upside risk that investors need to think about. You cover the Fed. Are you hearing anyone in your circles really assigning a strong probability of a rate hike at any point this year?
No, I don't see that as the base case scenario or even a strong scenario at this point. Of course, it goes back to what Inez mentioned, which is how long does this conflict last? Even if the two sides are able to get some sort of agreement here in the near term, it's still going to take a while to get a lot of these oil facilities that have been shut in back online, to repair the damage, replace all of the oil reserves that were being used on the market, to replenish all of that. So we could see oil prices remain higher for some time as we go into the fall. So we need to keep that in mind. But at this point, I think the Fed is more inclined to hold rates steady. And let's also take a step back, because so much has been focused on this oil price shock and whether that trickles down into core inflation. But remember, we're already dealing with an inflation issue. Inflation has been above the Fed's 2% target now for 5 years running. And Chair Powell addressed this last week. And this is not just because of tariffs on the goods side, but this is also because of services inflation, which has looked particularly sticky over the past couple of months. And so I think at this point, look, the Fed raised their outlook for inflation to 2.7% this year on a core basis. And a lot of that did not account for the oil price shock. To the extent that this does get extended and we see oil prices at $100 a barrel sustained into the fourth quarter, then you may be looking at a hike towards the end of the year. On the flip side, I just want to also mention that I'm not so sure we're going to see any cuts this year either. And I would point to Fed Governor Chris Waller's comments on Friday, because he noted that we're at a point where you need essentially on net zero job growth to have a balanced job market at this point because of immigration policies. So you could have a couple of months where you have positive data, you could have a couple of months with negative data. For the Fed to cut, I think you would need to see consistent negative job reports.
Jen, when is the Fed going to get rid of that 2% target? It seems totally absurd.
Chair Powell and the Fed have been questioned about this because essentially inflation, to your point, has remained above 2%, closer to 3%, right, for some time. But I think they're really trying to stick to that and jawbone markets and consumers to make sure that inflation expectations remain anchored. So I don't see the Fed abandoning that anytime soon.
Tim, I don't know if the Fed's checking out my Whole Foods meat section. I went there last week and I left the meat in the case. They were trying to charge me $37 a pound for some ribeye. I mean, that stuff is just ridiculous. That seemed like 100% inflation to me. But to Jen's point, how disastrous would even a signal of a rate hike be for these markets?
Yeah, it would not be good, Brian. And even just the fact that we've seen the cuts that were priced in earlier this year start to make their way out was really meaningful. If you think about what the setup that we had for the first couple months of the year before the war started, you had a great rotation trade that was happening. We started to see some pockets of the economy humming along that really weren't humming for the last couple years, and the AI cycle kind of broke that. But as soon as those rate cuts started getting priced out, we started to see those pockets fall. Think small caps, equal weight. And in order to see those pockets of the market working again, we're going to need to see those cuts priced back in. Brian, I don't think we're going to be in a situation where the Fed is even going to start thinking about a hike. We take a step back, what would that actually do? It's not going to bring oil prices down, and the filter through is still going to continue. So we think the hike in oil prices is going to destroy demand a little bit, which almost acts like or has the same effect as a rate hike. So we don't think the Fed is going to hike. But again, to get this rally back on the tracks where we need to be, we want to see those cuts priced back in, and that's not going to happen unless we see a swift end to the conflict in Iran.
Tim, is now the right time for the average investor out there to position for the end of the war trade? Whereas, they're make bullish bets on the market, whether it's through an ETF or they buy some consumer discretionary stocks on the view that oil prices go down, brings down gas prices. Is that the playbook people should be starting to run at this point?
So, Brian, I think the playbook right now in the short run is still to be cautious, and we want to prepare our portfolios for higher interest rates. We continue to see rates and equities moving in the same direction, and so there's a few things that we would advise here. One, we want to shorten duration on the fixed income side of our portfolio. We don't think it's worth it right now to go out there and take those bets. We want to be thinking about going up in quality in our equity allocation, really to protect portfolios. We want to be thinking about including more of those energy stocks that are going to continue to do well, even with the run-up that we've seen thus far this year. They're still trading at reasonable valuations. Obviously not the great valuations they were at the start of the year, but we still think those will help in this situation. And then continuing to add reliable alternatives. We've seen a lot of advisors in this crisis continue to allocate toward dual directional ETFs, which can help them provide a positive return even when the market is going down. So we think that's a short-term playbook. I will say, Brian, if we see a more meaningful correction, 5-10% in things like small caps, S&P 500 equal weight, I think it would make a lot of sense to nibble there because when this conflict does resolve and we start to see those oil prices go back down, those are the pockets of the market that we think are going to have the fastest catch up. So I think be cautious in the short run, but when we start to see some good news, start to think about allocating back to those pockets of the market that were really working well to start the year.
And as any stability have you seen today in the gold markets?
Gold is going up right now, by 2%, but it had been oversold if you talk to gold bulls, because it was down 15% through the start of the war. So right now you're seeing a bit up more than 3.5%. So perhaps if this war does not last as long as expected, that could be good for gold. But certainly gold, look, in the medium term, Wall Street's still saying the Fed's going to have to print at some point. At some point, this turns from an inflation story to a growth story, and then that means a dovish Fed.
Big thanks to my roundtable for today. Really awesome insights. Thank you, Tim, Jen, and Inez. All right, we get a lot of annual shareholder letters each year from big names in business. Warren Buffett made the annual shareholder letter famous at Berkshire Hathaway. Now the pressure to keep that alive will fall on Greg Abel. His first letter out a few weeks ago as CEO was pretty solid. Other letters I consume come from JP Morgan CEO Jamie Dimon, BlackRock CEO Larry Fink, and Amazon CEO Andy Jassy. These are all great reads as they provide helpful snapshots into how these market movers think about stocks, the economy, and their own businesses they run. One other annual shareholder letter I digest every year comes from American Express CEO Stephen Squeri. Squeri is one of the best CEOs in the game, and I also like that he grew up in Queens. Love Queens, just not the New York Mets. Sorry, not sorry, Steve Cohen. This year, Squeri shared a lot of his thinking on how AI will shape the legendary Amex business. I encourage you to go give it a read because Amex is all in on AI. And before you hit me on X, the answer is no. Squeri doesn't see the physical charge card vanishing anytime soon. And I kind of dig that. Here's what Squeri told me on the topic of tech change. Quote, when I started here in the workforce, you didn't have a PC, you didn't have an answering machine, you didn't have a fax machine. You brought things to the secretarial typing pool. And so I have to tell you, after 45 years of working, nothing surprises me anymore. I think just technology and the innovative spirit that we have in this country are making things easier. But the trick is ultimately it's going to be judgment and human interaction that continues to move things forward. And these agents are just going to unleash more creativity from a product perspective and more creativity from a marketing perspective and get rid of a lot of the mundane tasks that people are used to. I think a super long-term chart from Yahoo Finance shows how a company like Amex has navigated big tech changes in the past. Remember traveler's checks? They were those things made from paper before you used to tap to pay. That Amex chart, up and to the right. Coming up, I go inside the state of the housing market with Zillow's CEO. Don't go anywhere. I've been taking the pulse of the American dream the past 2 weeks on opening bid, or said differently, the pulse of the U.S. housing market. I've gotten insight into housing's biggest challenges from the property brothers Drew and Jonathan Scott, and a few good remodeling tips, of course. And I've taken a glimpse into the demand backdrop of the CEO of Rocket Companies. Today, I am putting the spotlight on how AI will change the home buying and home selling experience, as seen through the eyes of major player Zillow Group. The company is in New York City talking about its AI plans with investors, and is also out reiterating its first quarter and full year financial guidance. Here with me is Zillow Group CEO Jeremy Wackman. Good to see you. Thanks for coming in. I appreciate it.
Thanks for having me. Happy to be here.
I want to get right off the jump on AI, because we can talk about your business on the back end of it, but like, how is AI changing the home buying experience?
It's a great question, and it's really changing the entire home buying experience. That's what we're finding. We are launching today Zillow AI Mode, which is bringing an LLM inside of Zillow, right? So we've had AI capabilities on Zillow for a long time. Personalizing search, that's how we generate all that rich media you play with when you fly your drone around. But now you can have a conversation with Zillow, and what we're finding, even in the early days of using that, is people are just asking more and more questions. We're able to guide them further along in the journey, and we're able to really help them move along in the transaction from not just searching, but actually financing, offers, finding their agents and closing.
What are they asking these agents? Like, what are some of their biggest concerns right now when they're looking to buy a home?
Well, what's fascinating is how variable it is and how quickly, when you find out information, you want more. I think that's what people don't understand about the housing market. If you've been a buyer or a renter before, when it's time to transact, you spend all available time trying to make sure you make the right decision. We were telling a story to our investors of someone who came back to the same condo 16 times and just kept trying to figure out more information about it and compare it to the next one that he found. And
that was me. No, I'm just kidding. Where can I put my cold plunge, Jeremy? Where can I put my cold plunge?
That's right. But that is how this category works. You're only buying a house once a decade or more. It's your single biggest financial decision. So tools like Zillow, platforms like Zillow, where you can get information, the reason we have 235 million unique users is because they want to know and make sure they're making the right decision. So when you bring an AI tool to the fold, it just unleashes them to get even more informed, even more empowered, and it makes them more educated.
Is AI table stakes, when you talk to investors, what do they want to know from you on AI? I imagine it is more than saying, hey, by this date, we're going to make this amount of money. Like, they want to see, I guess, the whole product roadmap for you guys.
They do. I mean, right now, they're still pretty early questions. The biggest question we get is the kind of horizontal versus vertical disruption question still. Oh, this is changing all these verticals, and how's it going to change yours? And for us, it's a huge opportunity, right? We are a long, complex category transaction, right? Buyers are spending 2 to 3 hours a week over 5 months when they buy a home. And many investors are actually still learning that Zillow is not just a search site, right? We are a platform for the transaction. We have the software and the workflow for agents and buyers and sellers to not just find the home, but start to tour homes, start to get pre-approved, start to make offers, message with their agent, all the way up through closing. And so understanding how AI will come to that platform is really one of the biggest questions on their mind.
I was talking to the property brothers, very knowledgeable guys. Like, I get there on TV, but they know what they're doing. They're real estate agents, the whole shebang. And I was trying to figure out, like, what is the barrier for people holding their homes for so long? Folks that have owned their homes for 20, 30 years, they're not selling. Like, what has to happen to get them to sell? I mean, I don't know.
Well, mortgage rate lock is a real thing. Right, so there are many homeowners who are sitting on 2-3% mortgages.
From COVID.
Yeah, from COVID, and the idea that I'm going to go trade into a 6 or 6.5% mortgage right now, they're kind of delaying that. That's why you're seeing supply down, right? Supply is down really for 2 reasons. One, we haven't built enough homes, right? Zillow economists estimate we are 5 million homes underbuilt since the global financial crisis, just not enough new construction coming online to keep up with household formation. And now, the question you asked, rate lock. If you're a seller and you might have moved, but you didn't have to move, you probably put off that move. And so the demand to sell, the desire to sell, is at elevated levels because people are kind of sitting on the sidelines.
Is there a solution to all this beyond checking the website to see if mortgage rates have come down?
Yeah, mortgage rates help a little, but that's only a piece of the buyer affordability story, right? If mortgage rates come back down even a full point, it's not that much savings on your mortgage payment because home prices have run up so much, right? Home prices are up 60, 80+% from pre-pandemic levels, more in some markets. And the solution to that is more supply. And the solution to that takes a while, but it is a lot of programs to relax zoning and permitting and fast track modular and pre-approved designs and really work at the local level to get building in affordable housing going faster.
We have major home builders in this country. Why are they not building more aggressively? I was talking in our first show this morning on KB Home. They reported earnings last night, talked about some challenges with consumer demand, but they don't appear to be like, hey, we're gonna go out there and build all these homes. But the market seems like it would support them building all these homes.
Yeah, well, I'm not a home builder, but I can tell you that it's typically an incentive problem. And the reality is it happens in some places, but not in others, right? And so take Austin, Texas is a market where they've built a ton of rental inventory over the last however many years, and they've built for sale inventory. And in Austin, you look at rents, they've come all the way back down to pre-pandemic levels, and it's far off the peak. That makes renting more affordable, that makes buying more affordable, and that's even with the city growing and population growth and demand being strong there. So the reality is it can be done. It takes, it takes coordinated effort really at the state and local level to relax zoning, streamline permitting, provide incentives to not just get inventory online, but get it online in the affordable part of the market.
Is the rental market, it's been hot for you, but is it still really hot because people can't find a home, but also too, they can't afford a home if they really want to, if they see one on Zillow, for example, like it's too much, they can't afford it.
Yeah, so the rental business for Zillow has been growing, and the rental market has been one where rents are largely rising, not quite as fast as home prices, but the average cost of rent has gone up a lot too. But more folks are turning to rent. We find now that 60% of renters on Zillow's platform are also shopping to buy at the same time. That's always been a pretty big number. It's a really big number in my mind. And what that says is people want to buy, right? The demand to be a first-time home buyer is still there, but you have to do what you have to do. And when you make that re-rent decision, you end up renting. And that's one of the things that's great about Zillow's platform, right, is because we have the largest rental inventory in the country, we have the largest rental audience in the country because we can offer them the most choices. And then we have so many of those folks cross-shop, right? They might try and make the purchase happen, but oftentimes end up re-renting.
What are you seeing across the country? I follow the work by your economists, but you're here, so I'm asking you this. The AI boom has taken over this country. What are you seeing in certain markets where we're building data centers, or where we're even, I'm looking at the San Francisco market has been red hot. You can't even find a home to buy, and if you could, even with all your stock options, you may not be able to afford it.
Yeah, San Francisco is definitely a unique market right now. The reality of the housing market, it is highly localized right now, and you're seeing just as many homes with rising home prices as falling home prices. And you're seeing markets where affordability, which you define as kind of less than 30% of the average median income, can get you into a mortgage, coming back to those levels from as high as 40. But there's other markets where it's not. So to give you some examples, in the Northeast, a Hartford, a Buffalo, obviously here in New York, home prices are still rising, rents are still rising, right? There's not enough inventory online, and so sellers have the upper hand. But you look at markets like the Sun Belt or Atlanta or Charlotte, those markets, home prices are falling. They're down 4 or 5% year over year. There's more supply relative to last year than the average, and buyers are starting to find price cuts, and they're finding the upper hand. So it really is local right now, and it's kind of a tale of two cities on whether you're in a seller's market or a buyer's market.
Lastly, we're about to go into the spring home buying season. If you could find a home to buy, this comes at a time where consumer sentiment has slipped, you have war concerns. How do you see the spring buying season shaping up?
I mean, our economists in general have felt like modest relief in 2026, and despite all of the geopolitical challenges, I think you're still seeing that. Rates are remaining elevated. We expected them to stay in the 6s, and we expected not a ton of price improvement and not a ton of volume improvement, right? We did about 4 million and change existing home sales last year. We expect to do about that this year. The nice thing is price increases are slowing. Like nationally, home prices are around flat, right, with some up and some down. And as that continues to happen and incomes rise, that starts to slowly eat away at the affordability challenge.
Well, good to see you. I really enjoyed that slide deck. Loved all the AI you guys are working on. We'll talk to you soon.
Awesome,
Appreciate
thanks for having me.
Thanks so much. All right, Yahoo Finance, huge year continues to roll right along. Hot off the heels of announcing a game-changing partnership with Coinbase, we are back with more big news. Yahoo Finance will launch the Builders Hub, a new destination focused on entrepreneurs, startups, and small business owners, featuring content from partners including HubSpot Media and Entrepreneur. We will also debut 2 new original shows. The first is The Daily Wolf with Scott Melker, focused on all things crypto. The other is How They Run with Ryan Patel, offering a behind-the-scenes look at how CEOs and founders structure their days and make decisions. And last but certainly not least, We will be debuting a new homepage for Yahoo Finance with a refreshed look and feel that showcases the full breadth and depth of our amazing content. Love to see all of this. Market Catalyst is coming up next.
Welcome to Market Catalyst. I'm Brooke Obama in for Julie Hyman. We're 30 minutes into the U.S. trading day. Let's take a closer look at the U.S. major averages here. What we're seeing is in the green, the Dow, the NASDAQ, and the S&P 500 all hovering higher as we make our way into today's trading session following the U.S. sending Iran a 15-point peace plan, which we're hearing reports of that Iran is now rejecting, but investors largely optimistic that they will turn the tide and the duration of this war will be less than previously expected. Taking a look at the S&P 500 over the last 5 days, it's been a bit of a volatile picture here. Over the last 5 days, we do have the S&P 500 down about 0.6%, but once again today moving higher, up about 0.4%. Largely optimistic hope here that this war will come to an end. This also is largely predictive or largely inverse of what we're seeing in oil. As soon as we're seeing crude oil turn or reverse downward, we're seeing a boom, or rather increase in those futures as well. Crude oil down about nearly 4% today. And this is largely after, over the course of the past 6 days, especially on Monday, we heard from President Trump that this war could be coming to an end. And we saw that major decline in crude oil, down about 7.5% over the last 6 days alone. And today, as this optimism builds, we're seeing crude oil fall even more, down nearly 4%, now around $88 a barrel. And we're seeing a similar move in Brent as well. Similar reaction on Monday. pre-market trading session as well, down 11.6% and down 4.3%, now hovering around $95 after we've been hearing from so many on the street that we could see oil cross 110 or even higher, 120, 150 as we make our way towards year end. I also do want to take a look at what we're seeing with gold futures as well. We'll talk a lot more about this later on in the show, but interestingly enough, over the last month, what we've seen is actually gold fall off, down nearly 13%. This was largely seen as a safe haven asset, and we haven't necessarily seen that over the past month as investors are largely looking to get out, largely looking to see exactly how they're going to play into this war. And all in the background, we do have some momentum being regained in the NASDAQ today after a bit of a slide over the past month. In today's intraday trading, we are seeing some of the big tech names like Nvidia, Amazon, Tesla, AMD open higher. All this and more as Wall Street forecasters are raising the odds of a recession as the Middle East conflict continues, adding to the concerns that there are questions about economic growth in a slowing labor market. Joining us now in studio is Stephanie Roth. She's Wolfe Research Chief Economist. Stephanie, let's start there. We're hearing from Moody's, we're hearing from Goldman Sachs that they're increasing the likelihood that we could see a recession this year. What do you make of that? Are you predicting the same?
I mean, the odds are higher now that the energy prices are certainly rising significantly.
Right.
Is that my base case? No. I think realistically, we'll be in an environment where growth ends up being pretty solid. We have 2% GDP growth this year. And, the risks, of course, rise as long as energy prices stay elevated. So if we're sitting here in the summer and energy prices are $150, then yes, your odds of recession go up.
Okay, so wait and see mode here to see how exactly this all plays out, how long this war is, how high oil gets.
That's exactly right. We have to see, one, how long this plays out, and then two, how much demand destruction do you get?
Yeah.
So we have to gauge CPI airfares. Are you seeing airlines being able to pass through the costs associated with jet fuel prices? Mm-hmm. Are you seeing lodging prices fall pretty significantly because people don't want to travel anymore?
Yeah, and we did hear from United. They said that United said the airline prices could jump about 20%. How worried are you that we could see a slowdown in economic growth simply because the consumer is pulling back significantly?
I mean, that's the risk. That's what we have to gauge. Yeah. Base cases, that doesn't happen. But if it does, that's how this all unravels.
Mm-hmm. And headline inflation, you think that it could even increase as much as 40 basis points?
40 basis points per quarter. That energy prices are elevated. So it could easily be over 1% higher than what it otherwise would be.
And we went into this year with Kevin Warsh being the nominee for the Fed. There's been so much action, it seems like, and it's only March. So how does this all play into what you think the Fed will do moving forward?
It's a tough backdrop for the Fed. What do? They'll probably stay on hold for a while. Ultimately, we'll probably see some upward pressure on the unemployment rate, which will then keep them certainly on a hold, and if not a little bit more easy than the market is looking for. The market is looking for significant odds of a hike this year.
Yeah.
That's probably unlikely, but they'll probably have to shift a little bit more accommodative as they see the consumer pulling back.
But yet, the unemployment, their prediction, the Fed, they said that they expected to stay around 4.4%. Were you surprised to see that?
No. I mean, they didn't change their forecast dramatically because they don't really know how this is going to play out. So I think what they'll ultimately do is watch to what extent we're seeing some demand destruction, see how the data comes in the next couple prints, and then ultimately we might see some upward pressure because, by the way, AI never went anywhere.
Right.
That was big upward pressure on the labor market in terms of the unemployment rate, and that's still an issue. That narrative has not gone away.
Yeah, Bloomberg out today saying that data center capex estimates jumped 56% over the past 6 months. Where are we at now with this AI risk, this AI trade? Do you feel like we're beyond it? Have we even moved past it? Or are we just kind of putting it in the background as this war plays out?
It's just in the background, but it's going to come back to the forefront at some point in the next couple months. When we're not looking at oil prices, above $100.
Right. How concerned are you about the impact of AI on employment? We heard from Jamie Dimon, that's JP Morgan Chase CEO. We heard that he has some fears. He said specifically at a conference that if all of a sudden it creates unemployment, that's a big problem for society. What do you make of the impact that AI can have? We heard a lot about layoffs last year. Are you worried about that?
I mean, I'm certainly more worried about it than the market is. I think there's a legitimate possibility that this becomes an issue.
Right.
When we're starting, we've already seen some upward pressure on the unemployment rate because of it.
Right.
I think ultimately the economy will be better off because of AI, but that doesn't mean there's going to be there won't be disruption along the way.
Are you thinking at all about productivity? Because it seems like the Fed has kind of been dodging that question.
Yeah, I mean, it should be productivity enhancing, which tends to be an environment where you don't have inflation at the same time. So I think the bond market is just focused myopically on what's going on in energy prices, but we also have this tremendous disinflationary story tied to AI, and that will ultimately, I think, come back into the narrative at some point in the next couple of months.
And just to bring this full circle back where we started, how concerned are you right now about the low-income consumer? We got this one big beautiful bill. It was supposed to bring larger tax returns. Now with gas pressure, how concerned are you that the low-income consumer could pull back? K-shaped economy, is that still even a thing?
Yeah, it's still a thing, and the problem is gasoline prices hurt the very low end of the consumer. One big beautiful bill helps more of the middle-income consumer, so the squeeze will be more so on the very low end, so the cake kind of gets a little bit worse. And then the middle-income consumer could benefit at least a little bit. As of now, our estimates suggest that about 30 to 40% of one big beautiful bill is offset already by gasoline prices. That could rise as the conflict continues.
Wow, 30 to 40%. And then how long does this conflict have to continue to sort of offset it completely, you think?
So if gas prices if they rise to $5 through, say, September, then you offset basically all of it.
Wow. Wow. All right. Well, lots to go to. Thank you so much, Stephanie, for joining us in studio. I so appreciate it.
Thank you for having me.
See you soon. And coming up, understanding the impact of the conflict in the Middle East, why one expert says the sky is the limit when it comes to gas prices. That's next from Market Catalyst. Oil prices pulling back as President Trump says the U.S. is negotiating with Iran, even as Iran denies direct talks. According to a report from the New York Times, the U.S. sent Iran a 15-point proposal aimed at ending the war. Iran's mission to the United Nations also saying that non-hostile vessels are able to pass through the Strait of Hormuz if they coordinate with Iranian authorities. Yahoo Finance's Julie Hyman spoke to Dave Ernsberger, he's S&P Global Energy President, about the impact of the conflict.
Is the best case scenario for the oil industry, for the world, in terms of how this war in Iran might end up?
Well, one thing that we've learned in the last 3 weeks is that it's not a theoretical issue that the Strait of Hormuz is a crucial artery of energy supply. It is a reality. And I think folks who are in the industry knew that. It had never been tested before. But with that artery closed, we're now losing, as we know, 1/5 of global oil supply to the market, and also maybe about 20% of natural gas as LNG. So the best case scenario is that somehow some kind of agreement gets reached where Iran backs off its position of closing down the strait and begins to allow some vessels to go through. Typically about 130 to 150 vessels go through the strait every day. Right now, we're lucky if it's a half a dozen. Best case scenario is we get back to maybe 50, 60 a day in the near term. That will bring significant relief to markets, but it's only a starting point. The market would need to build its confidence from there.
And the industry, whether they're based there or they're based here, I mean, they're losing out on revenue every day that strait is closed,
right,
and the oil can't get, and natural gas and other commodities can't get to its destination. So one would imagine that they are, but they're in a delicate position, but that they're lobbying on the one hand to have this end, but on the other hand, they don't want to poke the bear, so to speak, and anger the administration.
Well, the Strait of Hormuz being closed is a global problem, including for the U.S. administration, but also leaders and policymakers and consumers as far away as Japan and Australia, China are affected by this, and of course Middle Eastern producers are too. So it is a global problem, needs a global solution to reopen that strait so that ultimately the energy piece of the global economy can start functioning normally again. We have not yet felt the true impact of losing 1/5 of energy supply in the global economy because it's only been 3 weeks. And to be honest, ships that loaded back in February are still rolling up at their destinations. It's the ships that were supposed to load in March and maybe April. When we start missing those, the economy is going to start to react. And that's why it's a global problem. Everybody's going to feel that pinch when it hits.
So gasoline prices, we've already seen them go considerably higher in the U.S., 20%, 30% in some regions. How much higher do you think that they could go?
Well, the sky is the limit in some ways. Our forecasting team at S&P Global Energy now predicts that if the war was to continue and the strait was to remain closed, we could easily see $200, $250 a barrel as crude prices. What that would turn into in gasoline prices has never been seen before on the streets of New York City, Los Angeles, Houston, where we are today. Never mind the UK, Japan, and Australia. So all-time record high crude oil prices can easily turn into all-time record high prices at the pump.
Connect the dots for me. What would need to happen for us to get to 200 or 250?
Well, status quo rolling on for another month can easily take us there. Okay. We haven't begun to feel, that's what I'm trying to sort of talk about with folks here.
Yeah.
There's a delayed effect of closing the strait now and then feeling the true effect in our pockets on a day-to-day basis, simply because it takes so long for a ship to sail from the Middle East to its destination port. It's when those first ships don't start to show up that we're really going to see markets react here.
Something else that we tend to hear a lot is that the U.S. is energy independent. And I think what this conflict shows is we're not really energy independent. We're a net exporter of petroleum products.
Yeah.
But we still rely on imports to turn into things like gasoline, for example, and obviously we're subject to the global oil price. So do we need to sort of rethink that whole energy independence line?
Well, actually, the U.S. policy through successive administrations of pursuing U.S. energy independence, this goes all the way back to Carter and Reagan, really, has been spectacularly successful. The U.S. does not have exposure to importing crude oil and even refined products the way that it did 10, 15, or 20 years ago. So, on a net basis, the U.S. is actually very independent of global supply, but the U.S. is part of a global marketplace. So when there are shortages in other parts of the world, in the world of oil, the oil that gets moved around to meet those shortages will come from America, unless there's some kind of export ban that's put in place, which people do talk about from time to time. It's hard to see the U.S. going down that road in a world where it's trying to reassure global markets that energy will be fine, and then putting in place things that would keep the energy here. Hard to see that happening. So, as long as the U.S. is interconnected as it is, a shortage in any other part of the world is a shortage here.
You talked earlier about, if this goes on for another month in part because of the delayed effect as well, we could see $200 a barrel. Is anything you're hearing this morning in terms of headlines, because we are seeing some hope in the market to some extent.
Yeah.
Is anything encouraging you that it's not going to last another month?
Well, most of the people that I've been talking to here at the conference and over the last few weeks are very pessimistic that there can be a solution to reopening the Strait of Hormuz, mostly because as long as the Iranian regime feels like it's under, existential attack, really, it will continue to at least threaten to do harm to ships passing through. And remember, all Iran has to do is threaten to do harm, and it's very hard to move ships through. And it's that level of uncertainty that has people in the industry pessimistic. But what I am optimistic about is that industry participants from around the world, including here in the US, have been making it clear that they would like to see the situation resolved. And if the industry speaks with one voice, typically administrations and military start to listen.
And the markets have also reacted, and we've seen in the past that President Trump has himself reacted when oil prices go up a lot, when bond yields go up a lot, et cetera. So perhaps that's the voice he's listening to.
Economic indicators and numbers that demonstrate value are hard to argue with, and I think that's the market speaking as well, for sure.
And finally, Dave, we've seen the administration take some steps, not just here in the U.S., but global leadership to try to mitigate this, right? Releasing strategic reserves, the U.S. lifting some of the sanctions on Russia and Iran, which would have been unthinkable a month ago.
Yeah.
Doesn't seem to have made much difference. Is there anything that can be done that would help more with that situation?
We have definitely seen some unexpected, unanticipated, very surprising statements, including the ones you just mentioned. The way to think about those is, how does every measure buy time? Not so much oil, not so much gas, but how much time does it buy you? The theory is, with the Iranian floating barrels being lifted from sanctions, that buys you a week. With the Russian sanctions being lifted on what's floating from Russia, that buys you another week. So each of these actions buys about a week of time. And that's what the administration is pursuing at this point.
Dave, thank you so much. Appreciate it.
Thank you.
Now time for some of today's trending tickers. We're watching ARM, Merck and Terns Pharmaceutical, and On Holding. First up, ARM shares are soaring after the company announced it will sell its own data center chips for the first time ever. ARM has traditionally licensed its intellectual property to other companies to develop their own chips, but now analysts say that the shift will allow ARM to benefit from bigger ticket purchases. The company expects to generate $15 billion annually within 5 years. ARM also announced that Meta is its first major customer as the social media giant ramps up its AI data center build out. Next up, pharma giant Merck is buying biotech firm Terns Pharmaceutical for $6.7 billion. The deal marks Merck's third multi-billion-dollar acquisition in the past year alone, as the company looks to expand its drug portfolio. Merck's active M&A plays also comes as its best-selling cancer drug is set to lose patent protection in 2028, that is. Terns is currently developing medicine for a type of leukemia, which has sparked consumer and investor excitement after promising results from an early-stage trial just last year. Finally, let's take a look at On Holdings, because its chief executive officer, Martin Hoffman, is stepping down in May. This comes as a surprise to investors, with an analyst at Needham saying Hoffman was, quote, the face of the company. In a statement, On says the mutual decision was made to preserve the company's entrepreneurial speed. On is no stranger to C-suite reshuffles after its co-CEO, Mark Maurer, stepped down last year. The athletic apparel company's co-founders will assume roles as co-CEOs. That once was a previous structure that it had after Martin Hoffman's departure. And I do want to get to some breaking news crossing the wire from Iran, outlining conditions for the end of this war. We are hearing from Iran's state-run press TV, citing official statements like Iran will end the war at its own choosing, also that Iran won't allow Trump to dictate when the war ends. They also went on to say that the war's end must include a halt to fighting on all fronts, and that Iran needs guarantee against any future attacks on the country. Once again, that is Iranian media citing what Iran says that it needs in order for this war to end. And we aren't seeing too much of a reaction. The Dow, the S&P 500, and the NASDAQ still holding on to the momentum, with the NASDAQ as much up as 1.3%. Crude oil also not seeing much of a reaction there. Crude oil still holding on around $88.50 per a barrel. Brent also not really moving too much, still hovering around $96 per barrel, but up a little higher from when we started the day. Crude oil started the day around $87, now $88.50, and Brent started the day around $93. And so just a slight touch higher as we're hearing this. And of course, we'll look out for any posts from President Trump. Largely on Monday, he did a post on Truth Social, and that got a large reaction from investors. We'll look out for that soon. But coming up, we are expecting to chat all more about what EVs can mean with higher gas prices. Higher gas prices could mean good news for the EV industry. Senior autos reporter Prasu Maranian joins me now with a closer look. So we've been hearing a lot about this, the potential that higher gas prices will cause more Americans to consider EVs. It seems like that's finally happening.
It seems to me making sense, but Americans are a fickle bunch, and they may or may not want to convert to EV. But the numbers are kind of pointing out something different. So Edmunds.com, they do an EV consideration tracking sort of survey, and they found that it's at the highest it's been all year since we've had these spiking gas prices. Gas touching $4 a gallon on average, and higher in most other places. And you've been seeing used EV sales are climbing up too, so that's good. But basically, when it comes to the gas price equation, Morgan Stanley did some numbers and said at $4 a gallon, the annual cost to run a regular gas-powered car is around $1,700 versus $700 for an EV. At that $4 a gallon price, EVs are 60% cheaper to run than standard gas cars, and every $1 gallon increase in cost results in $450 increase in fuel costs for gas-powered vehicles. This is real money. Like I said, you might be willing to pay that because you want to drive your big SUV or big truck. That's sort of the equation. But if you're just a person that's going from A to B, you can charge at home, or you have charging that's nearby. This might make sense, especially for a used EV, which I've written about too.
Yeah, and I always wonder, it's like, okay, how far do you have to commute to make this sort of make sense? And two, with energy prices going up in your home, is this going to end up costing you more to charge it in your house?
I think it's still cheaper to use regular electricity than actual gas, because you can charge at night when peak power is much lower, right? Yeah. And then you're just like kind of always topping up. You're not like doing a full charge all the time. Yeah. So that's why it makes sense. And EVs, let's be honest, are more efficient from an energy point of view than gas-powered cars. So that's why it all sort of numbers-wise, financially makes sense. The question is, do you prefer one or the other?
Right. I know. I haven't tried an EV yet, but maybe eventually, Maybe eventually. It's very quiet.
Fantastic.
Very quiet. But from driving to flying, because we've been hearing so much about TSA, United Airlines announcing a new relax row for passengers and economy. One, how does this work? And United Airlines also saying that ticket prices are already going to get more expensive by about 20%. So how much money will this cost you for a whole row?
Well, if you're United, you're seeing your business and you're seeing what makes a lot of money for you, and that's premium seating. The margins are so much higher for their Polaris class, which is their first class, and then other business classes and things like that, and premium economy being one more too. So this is sort of in between, right? This is basically, you can see the video there. So basically, it's instead of paying $3,000 to $6,000 for first class to go transatlantic or transcontinental. You can do this where you get 3 row seating in a certain area between main cabin and first and business. You get the full row there. You can lie down. You can actually have you and another person, or you and your child there, or have just a couch seating and just be totally relaxed for a long flight. So pricing wise, they didn't say how much it's going to cost. Obviously, it depends on the flight, but think about that. Think about how much it would cost to get 3 coach seats, right? Maybe you get a deal. Maybe you got to pay a little bit of a premium, but it's going to be significantly cheaper than getting first class or even business. So that's the bet there. They're the only North American airline that's doing that right now, potentially in the next year or two. So it's a bet on premium and people wanting to spend extra money. If it's you and your partner, maybe that makes sense for a long flight.
Right. I'm wondering, where are they storing those mattress pads in the flight?
They slide out.
They slide out. It's easy as that.
Yeah.
I also feel like too, with the price, the cost, everything's about value right now. So you're trying just to think, okay, where am I going to get the best bang for my buck right now? And maybe this is it.
Yeah,
they have the patent on it.
I said it's like, the joke is it first class for the rest of us? And maybe it is. But if you're United, it's actually making more money per seat or more row than in traditional coach. That's why they're doing it. It's a money thing.
And United premium revenue rising 9% in the fourth quarter. So that's definitely a good play.
Yeah.
Now, okay, so we did driving, we did flying. Now let's talk a little space, because you're also following SpaceX. The company might be ready to make its highly anticipated public debut. It's set to be one of the biggest IPOs we have ever seen.
Yeah, so basically what's happening here is the reporting from the information to others is that they're going to file their IPO, their confidential IPO filing as soon as this week.
Right.
Which means that's going to go to the regulators to be surveyed and looked at. We may or may not know what's in the filing. We might trickle out, but it's basically setting up an IPO for this summer, right? So like June or ish, that's what they're looking at. Could raise as much as $75 billion. We know about that. The investor portion could be 20%. That's sort of the float of the investor, like the open market float there. And it could reach a 1.5 trillion or higher valuation. This would be the biggest IPO ever, of course. But for Elon Musk, I mean, he owns 42% of SpaceX. So if the numbers are right, he could be the first trillionaire. That's what's happening now.
Pretty significant payday for Elon Musk on the way.
On paper, yes.
On paper, yeah. Also, I read that wireless spectrum firm EchoStar also owns a 3% stake in SpaceX, so that could benefit. Also, I was surprised here, Google owns a 6 to 7.5% SpaceX stake from a 2015 investment. So perhaps, too, that could benefit should the company go public.
Right. But also even Tesla, because Tesla bought a part of XAI, and then XAI and SpaceX merged. So now Tesla owns a piece of SpaceX, and it's all sort of coming together with Musk. You know, there's talk. I think Dan Ives of Wedbush said yesterday that he thinks that eventually Tesla and SpaceX would merge.
Would come together.
We shall see. I think they're more valuable separately, but if you're Musk, maybe you want to control over everything. That's probably the play there. But yeah, this SpaceX IPO is going to be huge this summer, but we might see this filing this week.
Yeah, and also on top of all this, on Monday we heard about the Terafab building, that another investment from Elon Musk, sort of bringing it all under one rooftop.
Yeah, exactly.
So
exactly, it's Tesla, SpaceX, and XAI. Yeah, 100%.
Yeah. All right, well, lots of headlines to look out for. Thanks, Ross. Appreciate you taking the time. And according to Polymarket, odds are 85% think that SpaceX will go public by September 30th, and 91% think it will happen before December 31st. So definitely watch out for SpaceX going public this year. For more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. And for the first time ever, service-based businesses like gyms, spas, and entertainment centers are overtaking retail stores. According to CoStar, just over 50% of total retail square footage leased in 2025 was to service-based tenants. Yahoo Finance's Josh Lipton spoke to the SkyZone CEO, Dave Hoffman, about how the company is taking advantage of the boom.
Maybe start here, Dave, for folks who maybe they've never visited, maybe they're unaware. Dave, just what exactly is SkyZone?
Yeah, so Josh, first, thanks for having me on this on the program. But we are the absolute global leader in active play, and that's important to differentiate from others. We're active play. We're not static entertainment. We've got nearly 300 locations across the globe. We target towards kids ages 6 to 14. We are 50% franchised, and I'm proud to say that we were just named one of the top 10 best investments for 2026 by Franchise Times. We had our best growth year in 2025, and we plan on building on that within 2026. The other kind of new news to this is we've introduced a new concept called Cloudbound, which is targeted towards kids 0 to 6. So SkyZone 6 to 14, Cloudbound 0 to 6. So we want to be a place where we can meet all of the parents' needs as their kids go through various forms of development.
You mentioned, Dave, sort of your core customer there, your typical customer. I'm just curious, has that evolved at all over the years, Dave?
Yeah, we've skewed a little bit older as we've matured, and there's certain things that we're bringing into the park. So it's a wide age range for SkyZone from 6 to 14, and what we try to do is separate the park into zones. So where we might have a toddler area, but then we've got sort of hyper-competitive kids who want to be on sports courts. They want to do 3-on-3 soccer matches, slam dunk contests. So we try to tailor zones for different types of kids' development, and all of that, Josh, is based on working with key opinion leaders. I was just on the phone with somebody from Cal Poly, who's one of our PhDs that we work with. All of our activities and our attractions are steeped into science. And in each individual park, we've got somewhere between 20 and 25 attractions that the kids can access.
What about pricing, Dave? What does a typical, SkyZone experience cost a family?
Yeah, so we are in the range of $20 to $25, depending on where you are across the country. And we think that is super competitive. That's for a 2-hour jump. But, Josh, as you know, the price to take a family out to a theater, to see a movie, to take them out for dinner, whatever, going to museums and aquariums, it's, we think we're a great value. And one of the things that we pride ourselves on is we want to be a place where kids can build friendships or bring a friend. So one of our membership programs, you get a free buddy pass every month. So we allow kids to come in, the members, and bring a friend every single time. So we like that aspect. And again, we think we're a competitive place for families. We know where gas prices are going. I was just watching some of your earlier programming. And look, this summer could be a staycation summer, and we're building programs and activities to accommodate those customers that are looking to maybe do something a little closer to home this summer.
At a high level, Dave, I'm just curious, what makes a location work? What makes what are sort of the key drivers for a successful franchise? Do you see certain trends?
Yeah, like one of the things we're looking at, what we really feel good about is not only the active play aspect for kids, but we have got a great real estate team that is hugely sophisticated on identifying site selection. And so about 50% of our sites are in either malls or in big boxes. And what I like about that, because what we're seeing, Josh, is there's a lot of bankrupt big boxes out there, and we're taking down these properties that are eyesores within the communities. They're aging bones. We're putting brand new sky zones within the community. So there's a lot that goes into the science of picking sites. We've got an in-house GIS tool that is a little bit techie, but it's how we look at site selection, and there's a lot into that. But again, the target audience is kids 6 to 14, and we cover the spectrum in terms of household income. So we're not targeting just one particular household income. We've got a range of people that we're trying to accommodate.
You do have rivals, Dave. Listen, plenty of competition out there for you all. What's sort of the Sky Zone edge?
Yeah, the Sky Zone edge for us is active play. Again, we are all about active play, Josh. And so a lot of the entertainment things that you're probably thinking about are very static. And look, in this world today, whether you say it's post-COVID, but there's more technology that is entering the household today. And parents are looking for an escape from screen time, and we want to be that place. Everything research that I've seen on cognitive development, social development, all stems from really great active play. So our mission is the power of play, full stop. And so we're here to create environments where kids can, again, self-express, build confidence, build friendships. And so to us, that is our secret sauce in terms of how we differentiate from everything else.
So it's all about physical activity, Dave, as you said there. But, I'm curious because, listen, I got a 6-year-old. Accidents happen, injuries happen. How much of a cost, of a liability is that, Dave, a risk?
Yeah, and look, Josh, I've been at retail for a long time. Health and safety is absolute paramount. We're dealing with our most precious asset, our children. And so we've got a safety council that is in-house and cross-functional. We've got a VP of safety and a safety team. So we believe we've got a lot of vigilance targeted towards this. We do a lot of training with our teams at the parks. And we scrutinize our attractions on a regular basis to make sure that they're the safest. So this isn't, it's never, there's always things that are going to pop up. But again, we're very active. We take this very seriously. And so safety is mission critical. The health and safety of our kids is mission critical.
Dave, so good to have you on the show today. Appreciate your time. Thank you.
Thanks, Josh.
Coming up, how stable coins are going mainstream and which companies could benefit. Stay tuned to Watching Market Catalyst. Stablecoins are quickly becoming part of the mainstream global financial infrastructure, with the combined market cap of major stablecoins reaching about $312 billion as of this month. That's up 50% compared to last year. Joining me now is Paul Golding. He's Macquarie Capital U.S. Head of Research for Technology. Paul, thanks so much for being on with us. I do want to start with an announcement that we got from the New York Stock Exchange yesterday. They're teaming up with Securitize to develop their tokenized securities trading platform. What do you make of this, and what does this mean for the stablecoin market overall?
Sure. Well, thanks for having me on, Brooke. I can't speak to names that we don't cover or news that we haven't written on, but we've written quite a bit. We've written extensively on the stablecoin theme and the tokenization of different real-world assets and how that can drive liquidity, how that can drive access and democratization of finance and retail holdings of financial securities by sort of breaking down those cross-border barriers, breaking down some of those fee structures and some of the rails that are managed or owned by institutions. And so we wanted to write this report that we published a couple weeks ago on the stablecoin theme because the crypto space or decentralized tokens have obviously been in a bit of a period of weakness here from a pricing perspective over late fall and winter. But that doesn't mean that the mechanical benefits, the technological benefits of stablecoin, the technology, the pegging of stablecoin to fiat and running it over a blockchain doesn't mean that those benefits have not seen uptake and stablecoin theme seen uptake amongst consumers and institutions. And so we wanted to expand on that. And one of those topics is tokenization of securities. We wrote about new tool being tested by Circle, their layer 1 ARC network, which aspires to do something similar to what you discussed in terms of the recent announcement.
I do want to hit on Circle because they actually had one of their worst trading days in history on Tuesday, now recovering just a bit. They are the issue of the second largest stablecoin here, so quite significant impact there. How concerned are you about these regulations, regulatory risks rather, and competition within the market? And what are you seeing there? Because you had said within that report that you had put out that Circle actually could be one of the biggest benefiters from this.
Well, we don't cover Circle. We cover the card networks, Visa and MasterCard, and we cover the fintechs, PayPal and Block. But in the context of the stablecoin theme, which all have some level of exposure to at least PayPal, Visa, and MasterCard do, Block, as of yet, would potentially, management has discussed potentially allowing stablecoin purchasing, but at the moment, no plans to have stablecoin issuance like PayPal has. PayPal has its own stablecoin, PYUSD. But in terms of the regulatory backdrop, we actually think the opposite of sort of the typical thought process around regulation adding complexity. We actually think regulation in the context of stablecoin gives some guardrails or guidelines that institutions that are regulated can feel more comfortable operating in. And we're seeing that with Genius. We've heard about progress in the news around Clarity. And so this could add some additional optionality for institutions to decide it's the moment to get involved because they understand the environment in which they're operating. So we actually see regulation as a positive.
So break down for us how you think Visa, MasterCard, and PayPal could benefit. And Paul, it seems like you think we're kind of at a turning point here within stablecoin adoption.
That's right, Brooke. I think we are at a turning point just in the sense that we see an opportunity. We see the market potentially sees an opportunity in growing liquidity, as I mentioned earlier, in US dollar denominated assets, or frankly, tokenizing non-US dollar denominated assets into assets that can be traded via US dollar stablecoin. And so we feel that the market generally moves in the direction of more liquidity. As noted earlier, blockchain-based tokenized securities or assets of any kind are available globally wherever that blockchain network web address can be accessed. And so that's sort of one area where we see the market potentially gravitating towards. We also see the opportunity for consumers to leverage the technology becoming more pervasive to enable more cross-border remittance that can be done more cheaply and instantaneously or virtually instantaneously. That allows for funds to be sent in US dollar terms, essentially, to friends and family in other countries. It also allows for retail consumers in emerging markets to hold US dollars vis-a-vis stablecoin. It's not outright dollars, but dollar-denominated assets, and essentially hedge their local FX. And so as those use cases become more prevalent, there's more mobile app enablement, more mobile bandwidth in some of these EMs, we see this proliferating, and that can become a virtuous cycle where financial institutions look to serve customers along those lines, and consumers look to financial institutions to provide those services.
Paul, lots of headlines to watch out for. I like what you said. You said that we see the market potentially seize an opportunity and growing liquidity. Paul Golding, thanks so much for joining us. Appreciate your time. And coming up, why gold isn't living up to its safe haven billing. You're watching Market Catalysts. Gold prices are climbing following President Trump's ceasefire proposal to end the conflict in the Middle East. But the precious metals haven't lived up to its safe haven billing as of late. After 9 straight sessions of daily declines, this is also the case for gold ETFs, as investors have struggled to find confidence in gold amid the war in Iran. Cullen Rogers is Wedbush Fund Advisors Chief Investment Officer. He joins me now for this week's ETF report brought to you by PIMCO. Cullen, break down for us, why hasn't gold seen a similar reaction that we've seen in the past?
I think a lot of this boils down to the construct of the sell-off. When you think about a traditional risk-off due to some macroeconomic decline, there's a lot of pieces that come into play that create this flight to safety. What we have now is a geopolitical flash in the pan, oil rising, hitting a soft spot in the economy with inflation. Instead of the Fed coming in to be more accommodative and increasing the likelihood of rate cuts, they're doing the opposite. And so you're seeing treasuries react like that, which traditionally would be a flight to safety. Gold, with real yields rising, is having trouble, especially on the heels of such an incredible year last year. And so again, I think it all comes down to the construct, and it's almost a relative term, flight to safety. It all depends on what is driving the exit of risk.
And one of the ETFs we were reporting on so much last year, I feel like we couldn't say it enough, was SPDR. We saw so many investors flock to it. Now that this sort of has seen a pullback, are you seeing investors think about maybe going back in, or are we still a bit hesitant there?
I think this all boils down to the uncertainty of the timeline here. Things are changing. Obviously, Trump is trying to accommodate the market and get everybody to feel safe that this is going to be resolved quickly. But at the end of the day, this boils down to how long this lasts. I think if this is relatively a short-term deal and oil comes right back down, I don't think it's going to snap down to 65 like it was last year. But again, it's all around the construct of uncertainty. The sooner that we get more definitive timelines, when the strait looks like it's going to be somewhat clear and we're going to get trade through it again, I think you'll start to see people return to a lot of those trades because, again, the fundamental macro pieces that were in place during all the rallies last year are still there. The macro picture does not look bad. And so it's what creates this difficult construct and uncertainty. And are we risk off for definitive fundamental reasons or just due to this short-term shock? So I think as we get clarity, people probably will return to those trades.
Colin, what are you seeing in terms of inflows to energy, to Bitcoin? Because both of those are seeing higher moves as of late.
I think, again, people are extending the duration of this, or at least they were the last few weeks, which is why you saw this, even maybe a flip out of gold and other assets into oil and energy companies. But again, I think that could change on a dime. There are so many dynamics in place here that are difficult to gauge the timeline on that we'll just have to see how it plays out. But, when you think about how to allocate for the next 1, 2, 3 years, is this the new status quo and is this going to keep continuing, or, are there other places to look?
And on top of all this, Colin, you also launched a core ETF, sort of looking at leadership styles and rankings. Now, this is a wide-ranging list of companies. So how exactly are you assessing leadership to translate to results here?
Yeah, so this is a fascinating product. We're super excited about it. Our entire goal is to launch these differentiated products that kind of look at things through a different lens, a new perspective. And we partnered with Indigo on this, and they spent decades building out a consulting practice and identifying what is leadership. And I think a lot of people think it's a CEO. And again, there are exceptions to the rule here where you have the Elon Musk, the Steve Jobs, the Bezos, that really are a character that can carry a company through charisma and kind of almost a persona. But for the other 480, 470 companies in the S&P 500 that people don't know the CEO's name, Indigo has developed this toolkit with a quantitative framework. It leverages AI. This wasn't possible 10, 15 years ago, to scalably analyze leadership execution across an entire firm. And that goes into the purpose of the company, the strategic alignment across the C-suite, the execution and action, what are they doing, what is it paying off for the company? And all of those pieces form a quantitative model that we can scale across an entire universe and invest in essentially a concentrated portfolio that overweights companies that execute.
Colin, I have 30 seconds. Is this the right way to hedge against market volatility?
Well, I think when you look at leadership, no one would argue that this is kind of something that every active manager has always looked at. And when you think about the construct of up markets, down markets, flat markets, what companies are going to do better? It's companies that are well led. And that's what we're trying to identify, an all-weather factor, so to speak, that can guide a portfolio core exposure through any market cycle.
Colin, thanks so much. Appreciate your time.
Thank you, Brooke.
That's it for Market Catalyst. I'm Brooke Chapama. Thanks for watching. More Yahoo Finance ahead.